So I'm going to go ahead and give it for Alicia.
All right. Rob is passing around just a little bullet point flyer for today. But I just want to give you guys the opportunity to ask as many questions as possible and have this kind of be a forum session where I can give you as much tax knowledge as I possibly can. So the name of the game when you're an accountant is not tax evasion, but tax avoidance. There's a big difference between the two. Tax evasion will put you in jail, you'll end up in fines. It's not correct. The alternative is tax avoidance, which is the legal way of using deductions and credits to reduce your taxes. So for small businesses, what we look at are different ways to reduce your income, therefore reducing your taxes. And there are three ways really to reduce your income. You can defer it by way of a retirement account or deferred compensation. You can take deductions, which would be things like mileage and rent and utilities, cell phone, etc. And the third way is to look at different credits that are available to small businesses. There are some pretty unique credits out there that a lot of small businesses do not know about. For instance, the health insurance credit. So it doesn't apply for yourself, but if you have employees that you are offering health insurance to, there are credits out there available that cover up to half of the cost of the premiums for your employees. So definitely some credits there if you have other employees. Other credits out there would be for hiring certain groups of individuals. If somebody is a veteran and coming back into the workforce, there are credits for hiring vets. If you are in an industry where you can hire somebody who has been in prison, there are significant credits for hiring an employee who has previously been incarcerated. For my work, obviously that would not work. But for some other, I don't think that you want a convicted felon working on your taxes. If you're in another industry, that might actually be a good way for you to reduce your taxes, is to hire somebody who's coming back out of the system. Let's see, other things would be offering employee benefits. And again, like most of these don't apply to yourself as a business owner, but if you have employees, you can offer all sorts of benefits. There's a health reimbursement arrangement, which allows you to reimburse your employees for the cost of their out-of-pocket expenses for medical. But if you do that, you have to offer it across the board. And there's an officer medical reimbursement plan, which I do use with a lot of my single-owner S-Corps. You can't do it with an LLC, but if you're an LLC taxed as an S-Corp, or you are a true S-Corp, we can set up an officer medical reimbursement plan, which allows you to take all of your medical expenses and make them pre-tax. Other things in the way of employee benefits would be tuition assistance for your employees. Again, doesn't apply to yourself as the owner, but you can reimburse your employees if they do take any college or training courses. You can also offer student loan assistance, which would be a deduction to you and a way for you to improve employee morale and keep some of those good employees around. And those are all deductions which reduce your taxable income and therefore reduce your taxes. Another thing that we work with our clients is on timing, because sometimes it can be very important to accurately time the taking of some of these deductions. For instance, if your business is in growth mode and we know that you're trending upwards, then we may not want to fully depreciate something in the first year. We might want to spread it out a couple of years. Or look at ways of timing things such that you're not taking a huge benefit in the beginning, instead spreading it out over time. So timing is very, very important in our world. As you move up in the world of taxes and your business continues to grow and you start using some of these strategies, it's very important for you to start using professional help. And so looking at using Maria, for instance, for your bookkeeping, And using a professional accountant reduces your risk of getting audited, reduces your risk of errors, and also will tie back to the better use of timing and making sure that you're doing the best you possibly can with timing some of those deductions and not using them when you don't necessarily need to. And again, in a way to reduce your risk is keeping good records, having good mechanisms in place for keeping track of income and expenses, and just making sure everything is, organized and always prepare for an audit. And always do your financial records as if an audit could happen down the road. So we help our clients get effectively organized, get in touch with the right people to make sure that their business is running smoothly and effectively, and then we end up doing the taxes, which if everything else is going smoothly, the taxes should go smoothly as well. So I'll stop there and ask if anybody has any questions before I move on to other stuff. Yes?
3 years is the new standard, is written here.
Yes.
Does that mean we don't any longer need to keep 7 years worth of records?
That is correct, and the IRS even posted it on their website.
Woohoo!
So it is official. It's 3 years from when you file. The reason being is that the IRS cannot audit back more than 3 years. So why would you need to keep them if they can't look back? The exception to that would be if you have rental properties. You don't have to keep all of your records, but keep any records specific to a rental property back to the time that you acquired it. Another exception would be if you own a home that is rapidly appreciating, and you think that you might get over the exclusion amount for capital gains, you want to have those records. Here in Boulder, it's actually very common to get above the $250,000 or $500,000 if you're married exclusion on the sale of your primary home. So that's where it's important to have, any improvements, stuff like that. But otherwise, the general standard is 3 years. And yes.
Okay, so you're an enrolled agent.
Yes.
What's the benefit of me using an enrolled agent versus a CPA? And when should I have to use you over a CPA?
So the biggest difference between a CPA and an enrolled agent, which I'm an enrolled agent, comes down to jurisdiction. So I'm licensed directly by the federal government, means I'm licensed in every state. And I have clients in over 30 states and 7 countries right now. So I focus specifically on taxes, whereas a CPA may not even do taxes. Their focus is going to be more on financial statements and accounting, which is actually different than taxes. So if you're looking for specifically tax help, an EA is going to be a better fit than a CPA. Okay. Anybody else? Yes.
Do you ever do like a soft audit for a business, like something where you just go in and check and see, like, here's where, if you were to be audited, this is where you'd be screwed up?
So anytime I meet with a new client, I always review at least 1 year prior returns, sometimes 2. It really depends on the situation. But I will absolutely, when I do that review, point out if you have some vulnerabilities or if you have some room for improvement. Not uncommon for us to go back and amend a return with a new client because we found that there were either significant errors or we could have done better. So, thank you. Good question. Yes.
What's a self-directed IRA? Never heard of it.
My boyfriend specifically asked me to bring that up because it's his favorite vehicle. So, over time, as we build our retirement accounts, we can later on merge them together and move them to what's called a self-directed IRA. Within a self-directed IRA, you can start to buy things like real estate. You can buy businesses. You can, if you're so inclined, buy gold, buy coins, buy anything that you wouldn't be able to normally buy within the stock market. So it takes it out of the control of your financial advisor, and you then assert that control. I love it for rental properties. No. And, but you really need to have at least 100,000 accumulated to then move into that self-directed IRA to make it worth it. But once you have that money in there, you can then go and buy other things. So I see it a lot with rentals. You can get a mortgage even with the self-directed IRA. So let's say you only had 100,000 to put down and you're buying $1 million house, your IRA can actually get a mortgage for the remaining amount. And then everything stays within that IRA and it can grow pretty rapidly. Yes.
How much influence have you got over someone who's been requested for their taxes and they refuse to release them?
Explain that a little bit.
Without naming names.
So say that again. If their taxes have been requested, what do you mean?
They've been requested legally to give up their taxes for the last several years.
Okay.
And then they have said, no.
Well, I don't have the authority to enforce that. The attorney involved would be able to find that person in contempt and have the court force them to produce those records. So that is a legal question, but it shouldn't be very hard to get those compelled.
We'll see how
Motion to compel is what you need.
Yeah, we'll see how it goes in Washington.
Yeah.
Okay. Well, we will see how that goes too.
No.
I think there might be a contender.
So we'll have time for one more question.
Okay.
So with the self-directed IRA, could you partner with your personal finances? With
No,
Okay.
it has to be completely separate. So you couldn't own half and then your IRA can own half? No. But you can own 50% as a tenant in common with another arm's length individual. So it could be your IRA owns 50% and your spouse owns the other 50%. But it would have to be like a true like tenants in common situation. And you can't blend the money. But it couldn't be you and your IRA. Unless you're buying a company. That, if you're buying a company, which we have had this happen, you can own a part or a certain number of shares and then your IRA would own a certain number of shares. Yes.
I just wanted to make a point on the real estate side of buying through an IRA is that you have to be completely hands-off. You cannot enter the property. You can't be anywhere near the property. It has to be completely monitored and maintained by a property management company, such as All County Board.
Yes. I know we ran out of time, but I know Maria has a question.
I just wanted, and if you answered this, I'm sorry while I was doing cards, but why is it important for you to know if there's a home purchase or business loan application?
Because we might treat your expenses differently on your taxes. For lending purposes, they add back in depreciation in home office. And we may not normally spend the extra time to put things into depreciation into your home office, but if we know you're going to buy a house, those things will get added back in. So it's worth it for us to spend the extra time to do that. Anything else?
I guess if you need to know more information, you could always schedule one. We'll leave you hanging there.